Alright, here we go. I don't know why the hell I'm doing this, but here I am, sorting out some accounting SAC style questions to get you better prepared for the Unit 4 Area Study 1 SAC. So today, I figured I'll just focus on depreciation and disposal of a non-current asset because I feel like it's one of the harder aspects to balance day adjustments. So, let's work on an example. On July 1, 2023. Tom L. started his own business called Best Roasters, a small business that prepares reports on an annual basis on the 30th of June. On the same day, the business took out a loan for $40,000 from Daniel B. Bank. The business then purchased a roaster for $58,000 plus GST, with EFT 294462. Alright, if you didn't know what a roaster is a machine used to get coffee beans ready so it can be turned into awesome coffee. So, how do we record the general journal entries for this transaction? Well, here you go. Is figure out the loan amount to record. In this case, we know we borrowed $40,000. If we borrowed $40,000, it should create an increase in our bank account and an increase in our loan. Bank being an asset, to increase an asset, you always debit. And to increase a liability, in this case the loan, you would create a credit, and hence why we have a debit of $40,000 for bank and a credit for $40,000 on the loan. Hopefully that's straightforward. If not, you have to go back to Unit 3 accounting and really brush up on your debits and credits, unfortunately. Next up, the purchase of this non-current asset. So we know it's going to cost us $58,000. We're going to obtain it, so that roaster is going to be $58,000 worth of value to our business. Therefore, an asset. So we need to debit this value as located here. After that, you got to remember the GST attached to a roaster. Anytime we have a sale of GST, it creates a liability, but whenever we pay for GST, it creates an asset. So that's why we debit the GST clearing account by $5,800, because this is giving us economic benefits, not taking it away. So 9 times out of 10, GST clearing is a liability account because generally there's more credits than debits, so it's safe to also say that in this case it will reduce our GST liability by $5,800. Alright, anyway, after you've accounted for the $58,000 for the debit and the $5,800 debit here for the roaster and GST, you need an associated credit. And we know that they paid for it using EFT, meaning it was done by cash. Therefore, it's going to be a credit of $63,800. Our debits equal our credits, we are all good to go. Debits equal our credits, all good to go. And this is the marking allocation guide if this was, a potential SAC or exam question. 1 mark for recording the bank and the loan correctly, 1 mark for the for the roaster, the non-current asset, and the GST, and then 1 mark for the bank entry related to the roaster. Okay. So, another question, a theory question, because 40% of your SAC or exam is going to be theory. You could be asked something like this in terms of depreciation of an asset. So, explain how Tom should determine the appropriate method of depreciation for a roaster. In this case, how are we going to get the 4 marks? Well, first off, you better state the revenue earning pattern of the asset and link it to matching the appropriate level of depreciation to that asset. Once you state that, then you just state why you would use one type of depreciation and then state why you would use the other type of depreciation. So let's take a look at this question. So this is a sample response I've written. So the roaster has moving parts and a variety of failure points that can contribute to the asset providing more revenues in its early years and less as it gets older. Therefore, we should match the revenue earning pattern of the asset with the appropriate rate of depreciation. In this case, it would be suitable to use the reducing balance method of depreciation. The reducing balance method allocates more cost in the early years and less in the roaster's later years, when it's less productive, and therefore matches the roaster's revenue earning pattern with the allocation of expenses. If the roaster is expected to generate the same amount of revenue each period, the straight line method should be adopted as it allocates the same amount of cost each period. So there you go. There's your response. Open up with stating that, you know, revenues, the revenue earning pattern of the asset should be matched with a similar pattern of expense. Then go on about why reducing balance is appropriate for this particular asset, and then go on about why it's appropriate to use straight line for this asset. I'm hoping that most of you guys realize that a roaster has moving parts, quite a few different value points as I mentioned here, therefore you would use the reducing balance method most likely. So, another question that could pop up. Tom decides to proceed with the reducing balance method of depreciation using a depreciation rate of 10%. My goodness, I can't speak. So at the end of Feb 2026, we sold the roaster for $35,000. Remember, reports are done annually at the 30th of June. So we need to complete the general journal entries to record the disposal of the non-current asset. So this question's a bit cheeky in a sense, because not only is the depreciation on this asset on an annual basis, but we didn't even have the asset for another full year before we got rid of it. So we need to figure out a fraction of depreciation for the year in this transaction. And because we're using reducing balance depreciation, it's not as simple as just figuring out 10% of the historical cost and we're done. We have to do a lot of manipulation before we get the depreciation rate. So let's get started. So here's the details, and these are the steps we need to do. Step 1. First we need to calculate the rate of depreciation for the period and record it in the general journal. Followed by step 2. Reversing the asset and the accumulated depreciation on our balance sheet. Next, we need to record the proceeds of sale, and lastly determine if we make a profit or loss on the disposal of the asset. So let's work out the calculation of depreciation, probably the hardest bit to figure out first. Here are the details. We purchased it on July 2023, the 1st of July 2023, and we got rid of it on the 28th of Feb 2025. Reports are done annually 30th of June. The roaster's historical cost is $58,000, so that's how much we bought it for originally. And the reducing depreciation is at 10% per annum, so I was meant to write reducing balance depreciation, my bad. So first up, we need to figure out depreciation on year 1. Depreciation on year 1 is $58,000. 10% of $58,000 is $5,800. So the carrying value on the first year of the asset is $52,200 after we account for depreciation. Oh, probably something I should note also, if you didn't know already, reducing rate depreciation is doing 10% off the carrying value of the asset, not historical costs. So make sure you always do it off the carrying value. In this case, because the asset's brand new, the carrying value is the same as the historical cost. But on the second year, you get a notice that the carrying value of the asset's $52,200, not $58,000. So in the second year, depreciation, we know we own the asset for 8 out of the 12 months. Therefore, we need to base the 10% depreciation on the ratio of 8 to 12. How do we know it's 8 months? Well, let's do a little basic calculations here. Let's get a calendar. I didn't even think this through. Alright. Calendar. Yeah, this will do. Open a new tab. Whoa. This is taking a long time. What a fail. Alright, let's try this one. It's the same one. Being stupid. Alright, it's finally opening. Yeah, alright, this works. So we got rid of it at the end of Feb. So how much time is there left until we get to end of June? We got March, April, May and June. So 1, 2, 3, 4. So there's 4 months of depreciation we don't need to account for. So 12 take away 4 is 8. So therefore that's how we get our 8 out of 12 months is the depreciation for that year. Because 4 months of that year we didn't actually use that asset, we already got rid of it. Therefore, once you do your 52,200, times it by 10%, figure out what 8/12ths of that percentage is. In this case it's 3,195. Therefore the carrying value at the second year is 52,200, take away 3,195 to give us $49,005. The red representing the carrying value at the end of the second year. So, now that we know our depreciation for the second year, we can finally record our general journal entry. Let's do it. Here it is. Depreciation of roaster and accumulated depreciation of roaster. Now you're probably thinking, wait a second, didn't we get rid of this asset on February? Why are we doing the depreciation on the 30th of the 6th? Well, remember, balance day adjustment happens at the end of the period. Alright, so I reckon this would have caught some students out if this was an exam or SAC question. So just be careful the cheeky little details that they put sometimes in SACs. Alright, this is what distinguishes those students who get a 50 in this subject. Alright, step 2, the reversal of the asset. So the reversal of the asset in this case is highlighted in purple for you. So we know that we originally purchased the roaster for $58,000. It had a debit value, so we need a credit value to write it off back to zero. Remember, when we dispose of an asset, your associated account is always going to be disposal of whatever the non-current asset is. In this case, a roaster. So we know we're going to credit the roaster. Our debit has to be disposal of roaster for the same amount. Accumulate depreciation of a roaster. It's a negative asset account. To increase the value of a negative asset account, we have to do a credit. Therefore, to reverse it back to zero, we need to do a debit. And as before, the associated account tied to a disposal is always going to be disposal of the roaster. So in this case, we're going to credit disposal of the roaster. So that's step 2. How do we get 8995? That's probably a good thing to explain, because I've assumed here that you understand what's going on at this point. This 8895 is our total depreciation, accumulated meaning total depreciation. We got it from the 5,800 from year 1 plus the 3195 from year 2. These two together gives us the 8995. Okay? Third step, proceeds from the sale. So highlight in purple here. We know back here that we got rid of it on the 28th of February and we got $35,000 for it. So $35,000 goes into our bank, and the associated account is always going to be disposal of the non-current asset. If I haven't stressed this enough, it's always related back to disposal. Disposal, disposal, disposal. Alright, so debit and credit the same amount. We're all good. Everything's balancing out. Step 4, figuring out the profit or loss on disposal. So this can be difficult, but it doesn't have to be. We know that the asset was $58,000 and accumulated depreciation was $8995. The difference between the two represents our carrying value. So if I get a calculator out and chuck it in, 58,000 take away 8995 gives us $49,000 and $5. So 49,005 is how much we should get for the asset. But what did we get? 35,000. So the difference between these two is 14,005, and that represents our loss because we were meant to get $49,005 worth of value, but we only got 35 in the end, so we made a loss of $14,005. A loss is a debit transaction, therefore we do a loss on disposal for the debit and always link it back to disposal of the roaster, 1405. So there you have it. That's how you get your 6 marks here, and I've put the mark allocation up here. Correct figure of depreciation, and then record depreciation into the journal, then the 4 marks in relation to the disposal. So in this case, you get 1 mark for these first 2 lines, 1 mark for these 2 lines, 1 mark for these 2 lines, and 1 mark for these 2 lines. Did I say that correctly? No, I didn't. Let's go back. Alright, so 1 mark for disposal roaster and roaster, 1 mark for accumulated depreciation roaster and disposal roaster, 1 mark for bank and disposal roaster, and then the last mark for loss on disposal roaster and disposal of roaster. 1, 2, 3, 4. 4 steps, 4 marks. Alright? And then the final question you usually get, it's like the bread and butter question to ask after you get a loss or a profit on disposal. Normally they would ask you to explain why there was a loss or disposal on the disposal of the non-current asset. In this case, we got a loss on disposal of the roaster, so we need to explain how that's possible. It's 2 marks, so normally you get 1 for stating that the proceeds of the sale is less than the carrying value, or the proceeds of the sale is greater than the carrying value if it's a profit, and then detailing why through depreciation and its useful life, the reasons behind, the loss or the gain. So for this question, your answer will be as follows. A loss on disposal of the roaster occurred as the proceeds received from the sale of the roaster was 35,000. Sorry, 35,000 was less than its carrying value, 49,005. This is due to an under depreciation of the roaster due to overestimating the roaster's useful life. So if this was the opposite way, and you had to explain why we experienced a profit on the disposal of the asset, just say that we over depreciated the roaster due to underestimating the useful life of the roaster. Okay? And that's it, folks. That's one challenging question for you based on disposal and depreciation of a non-current asset. Next time when I make a video, I might do it based on accrued and unearned revenues. Anyways, stay tuned. Hope this video was useful. See you around.